I would now like to introduce today's presenter, Ray Cronin, co-founder and CEO from Club Benchmarking. Club Benchmarking's Onware software platform allows private clubs to benchmark their financial and operational performance against other clubs in a strategic manner. Ray has presented at numerous industry conferences and has presented the concept of strategic benchmarking, the available cash model, and governance as leadership to club boards across the country. In addition to his club benchmarking duties, Ray is the president of Thorny Lay Golf Club in Brockton, Massachusetts, and is a member of the board of So Can You, a community foundation. He received a BSEE from WPI in 1980 and an MBA from Harvard Business School in 1985. Ray, thank you for being with us today. I'll now turn the presentation over to you.
Thank you, David, and good day, everyone. Today's topic is capital investment. We're going to dig in, I guess, as usual, with some club benchmarking presentations. We're going to look at a lot of numbers, but from those numbers, we will be able to draw, I think, a couple of important points. So thanks for the ability to do this. So for the agenda, I'm going to talk a little bit about, what we do at Club Benchmarking with the data that we've gathered with CMAA from these clubs all across the country is we basically just overlay a standard business financial footprint, a framework on top of the data. And with that financial framework, as in any industry, we can learn about the business in any one participant or club, in this case in the business, by looking at the industry or at a club through that common framework. One of the critical issues in any industry, and certainly in clubs, is the concept of capital investment, and that it revolves around what investments to make, when to make them, and what the return on making those investments is. A fundamental aspect of business is making sure that money or capital that's invested in a company or a project has a return that's beneficial to the business or the club. So we're going to take a quick look at return on equity and return on investment. And then we're going to dig in to what I basically call the investment return cycle. This whole concept of making an investment, a financial investment, and gaining a financial return as a result. And we have some what I believe is very insightful and compelling data by looking at the club industry on a whole. And I think anything that we'll see this afternoon, this morning for those in the Pacific time zone, can be applied at your own club. There's a couple of ratios that I'll mention that I think will indicate whether an investment's productive or not, and what the result of an investment is. And I think any club that's any member of any club that's on the webinar today will be able to quickly calculate those ratios for your own operation, and I think maybe gain some insight as a result. And as David said, please feel free to type in a question. We'll take them in real time. I think it's best that way to keep the dialogue flowing. So in the business world, this concept of return on equity, or ROE, is a very important concept. And if we look at it just quickly in the standard business world, outside the club world, we probably can gain some helpful insight. But the concept is that capital, which is the money invested in a business, is deployed ultimately. If you think about the folks that have the money, whether it's people that buy stocks, or we as individual investors, if someone comes to ask us for money to start a business, or mutual funds, etc., that money is deployed to managers to deliver a product or service to a marketplace with the intent on delivering a return on the capital deployed. And I think generically speaking, the concept is that if there's more risk associated with the investment, the return will end up being higher, or should be higher. And if there's lower risk, there'll be a lower return. If you look at the little chart off to the right, I just found that quickly on the internet, one of the financial websites. It just kind of shows the return on equity. I think it was for 2013 that year, based on their analysis of the marketplace and different industries. the return on equity in, 7 or 8 core industries in the country. And you can see basic materials, where those have to be used, there's very little risk. They go into different products, different parts of the economy. The return on equity is lower, whereas technology, making cell phones or computers where things move fast, where there's a lot of change, a lot of competition, the return on equity is higher because companies come and go very rapidly. We can look at Nokia as an example on cell phones. At one point, they were #1 in the world. Now we don't know where their cell phones are, or we don't see them. So they have to have a higher return because it's higher risk. The return on equity ultimately is simple. It's just the annual profit that's made delivering the product or service in proportion to the amount of equity that's deployed in the business. So owner's equity. If you go to any company's balance sheet, you'll see a line item that says shareholders' equity. And if you take the net income of the business and divide it by the shareholders' equity at the end of a given year, that's the return on equity for that year. So it's simply the profit divided by the owner's equity. Now, in the club world, that same concept actually exists, and what we're going to see today is data that we've analyzed that relates to that. And there's some very interesting insight that we'll see from that. But the concept of return on equity exists in the club business, even though it might sound counterintuitive, because of the fact that many member-owned clubs, as we know, are not-for-profit businesses, but there's still a way to determine how the equity is being deployed in a given club. And we'll dig into that in detail as the webinar evolves. There's another measure that's used often in business. It's called return on investment. And the way I like to think of it is return on equity is a higher level measurement. The return on equity is looking at it from the overall business standpoint. Within a given business, though, there are many decisions that are made on various projects, one against the other. In the case of a club, we might say a club could be faced with the decision of 5 different potential capital projects. One might be to renovate and redo the pool. One might be to install new heating, ventilation, air conditioning units. One might be for a new roof. One might be to build a golf learning center. So those are all capital investments, and each of those projects would have their own return. And when you put those into a bucket with all the other investments that have been made over time in a particular club, and you add that up to the total equity invested in the club, that would be when you're looking at return on equity. But when you look at each individual project, we'd be looking at return on investment. And what we try to do with the return on investment calculation is to compare the relative financial merits of each of the projects against each other. And ideally, it's not the only way these things are measured, but it's clearly one of the typical ones. But the concept is you try to invest money where the greatest return will accrue to the owners. And that return occurs in this particular case, if you look at it on a project-by-project basis, it could be that the revenue will increase and provide more profit, if you will. It could be that the costs, you're not necessarily going to have more revenue, but the costs, if you take the HVAC example, suppose you have a club that has 20-year-old HVAC units versus up-to-date ones, it's most likely that the newer ones will have lower operating costs than the older ones. So while the revenue of the club isn't going to increase because of the new units, there might still be a return on the project through the lower operating costs, and you could actually measure that return. And so the calculation ultimately is the return on investment equals the increased profit, be it through increased profit or lower costs, divided by the amount invested in the project. It's a pretty straightforward calculation that I'm sure we're all familiar with. So ROI and ROE are 2 very common measures that exist. I heard this statement along my travels, and it resonated with me. I think it's a great statement. In the member-owned, not-for-profit club world, someone said to me, not-for-profit is a tax status, not a business model. It's a great statement. The reality is that clubs, as we all know, we have two ledgers in a club. We have the operating ledger and the capital ledger. And if you look at the operating ledger, there are clubs that run with an operating surplus. In fact, if you're just very precise about it, about half the clubs in the country have an operating deficit annually, and about half have an operating surplus. So you can, as a club, have a surplus, and what happens with that money is it gets shifted over essentially to the capital ledger, and it's available then to make capital investments or increase reserves or pay down principal on debt. So because we're not for profit doesn't mean that we shouldn't use terms like ROI or ROE in the industry. As a matter of fact, I would posit the hypothesis that using such terms in the boardroom of a club will help the club because the folks arrayed around the table are very familiar with these concepts. I think this helps focus board members actually and keeps them out of the weeds. We're constantly looking at the data at club benchmarking to ascertain critical ratios that are easy to grasp that help the board focus on the key strategic issues so they're not sitting in the board meeting asking all the folks on this phone why the cost of food is 40% instead of 25%. It turns out, and I'm going to show this, I believe, during the webinar, but the concept of return on investment or return on equity in a club is actually generally driven by increased capital income in the club. And we'll take a look at that. And I'll just tell a quick story here. This analysis kind of grew out of a club that I had done some work with benchmarking data. It was helping the club. And let's say that the club, as by the way, do half the clubs in the country, probably are not generating the capital income that's necessary to properly maintain and upgrade the facilities as time moves forward. The club was overly focused on tactical issues like why don't we make more money in food and beverage rather than looking at the big picture. And in the work that I had done with the club, I heard a story, and the story was that about 5 years ago, the club invested a princely sum of capital on the order of $5 million into upgrading. The clubhouse needed updating. They invested first in upgrading banquet facilities. I'm not going to judge the decision. I just know that the return on that investment probably would not be something that would be applicable or attractive in a typical business. The club, as do most clubs, 75% still had a loss in F&B, and so I was thinking about it afterwards, and I was thinking this particular club had a very nice location, one where had the members side of the house, so to speak. If the $5 million went into that, it probably would be pretty logical to conclude that the club, there'd be more members desiring to join the club. The club's doing fine with members, but they'd have a greater demand, which would manifest itself through a higher initiation fee and potentially greater dues revenue, obviously. And so that started me to thinking about this concept of making sure that the capital that we invest when we make decisions does provide a return for the club. And that's the whole purpose of this webinar. So in that...
Ray, I'm sorry to interrupt. We did have a question come in.
Sure.
The question was, how many years do you use to evaluate ROI?
So ROI, there's different approaches to it. You could use the asset, the life of the asset. You could do it looking at it on a discounted cash flow. There's different mechanisms to actually measure it. and you have to figure it out. I mean, it's just it could be just a simple lifetime calculation over the life of the asset. If you take the HVAC units as an example, and they have a typical life of, let's say, 10 years, and you invest X, and over those 10 years, you're going to save, 2X in operating costs, that would be a fine way to do the calculation. You don't even have to bring time into it. So it could be based on the length of the asset. It'd probably be the most logical. There's other mechanisms like internal rate of return or other things, discounted cash flow, et cetera, where you would discount those returns in future years as well. So there's different ways of measuring it. Time does enter into the equation, but the driving factor of time would be the lifetime of the asset in which you're investing.
Okay, thank you.
Thank you. So in leading into the data now, I want to try and put this concept on the table, please, which I'm going to use the term the investment return cycle. So it's the concept of we do make an investment, but there will be a return on that investment. And as a place setting for that topic, in our key performance indicators that we have discovered at Club Benchmarking, I don't say we develop them, we discover them because they relate. We know these metrics relate to financial success or lack thereof in clubs. One of the most critical of the 15 KPIs is what we call net available capital. And what that is it's simply the ultimate bottom line for a club at the end of a given year. It's the amount of money that's available for the club to make capital investments, pay down debt, or increase reserves. And the equation to calculate it is this. It's your total capital income from the capital ledger. That's all your initiation fee income, capital dues, and any capital assessments or any other capital income you may have had that year, plus the operating bottom line. So there's two possibilities there. You may have an operating surplus, which would get added to it, or you may have had an operating deficit, which would get subtracted because you have to fund the operating bottom line, obviously. And then finally, minus all the lease expenses. There's been an accounting change which will take place. I heard Phil Newman last week. He gave me that he was doing a panel. I heard the date. I think it's 2020. I'm not 100% sure. But all leases are essentially going to be capital leases in the next few years. But we've already had this model where we consider lease expenses, whether they're operating or capital, a capital expense, a capital flow rather than operating. It's beyond this webinar to get into why we do that, but we do. So you subtract your lease expenses. So that would be cart leases for the golf carts or your golf course maintenance equipment leases, et cetera. So that's your net available capital. Capital income adjusted for your bottom line. If it's a deficit, you subtract that amount. If it's a surplus, you add it, and then you subtract your lease expenses. We believe that that amount of money should be somewhere between 12 and 15% of a club's operating revenue year in and year out. So that's a very quick ratio that anyone can do in a matter of 5 to 10 minutes that will give you a very good indication of where you stand. And we're going to look at this data in detail. But then the question becomes kind of what do you do with that money if you're going to make capital investments? And that's the first half of the investment cycle, investment return cycle, which we'll take a look at this now. So first thing we do when we did this analysis, and I hope you can see these numbers on your screens. They're a little bit small, but I'll read them just to make sure. But we looked at the distribution of net available capital ratio across the entire industry. So what you see is at the 25th percentile, it's 5%. At the median, it's 11. And at the 75th percentile, it's 17. So that means a quarter of the clubs in the country have a net available capital ratio of 5% or less, and a quarter of the clubs have one of 17% or more. And remember, we think that a club, to keep itself in a consistent manner, be able to reinvest in itself holistically, year in and year out, should be between 12 and 15%. Now, if it's over, that's not an issue, obviously, but if it's under, it is an issue. So you can see that about half the clubs in the country don't meet that threshold. In about a quarter of the clubs, that lower quartile, so the group of clubs that have a ratio of 5% or less, that's what we would refer to as capital-starved clubs. Now, that's a quarter of the industry. On the other end of the spectrum, the clubs that have a greater 17% or greater ratio, let's call them capital-rich clubs. And today what we're going to do is we're going to dig in to what goes on with capital monies in those two groups of clubs. So that's half the industry. We're going to look at the capital-starved clubs and the capital-rich clubs side by side to see if we can discern any insight that would be of value in running our own clubs. And I will say, going to the punchline, I absolutely think we can see some things that are frankly critical. So that's the first. Now, if you look at it, if you look at the net available capital ratio, this is like we just zoomed in. All we're doing here is zooming in on the lower quartile and showing that distribution, and then zooming in on the upper quartile and showing that distribution. So the capital-rich clubs, you can see the median for that quarter of the industry is 22% ratio, whereas the median in the capital-starved clubs is 0%. There's actually clubs that are consuming themselves, if you will, at the end of the year. They don't have excess cash. They actually have less money. They've taken on debt or they've eaten into reserves, but they don't have any money to make capital investment. So that's about 1/2 of the lower quartile, okay? Let's look first at a metric that we have in the database that is capital investment in relation to operating revenue. So how much are clubs investing? And this number's fairly consistent year to year. The capital-rich clubs, the median is 10%. In the capital-starved clubs, it's 6%. It's almost half of that. So if you look across this distribution, what you see is 18% at the 75th percentile in 10, 10 and 6, and 6 and 3. So capital-starved clubs, the ones with that lower ratio, now it makes sense, they don't have as much money, but they're investing half as much of their revenue year in and year out as the capital-rich clubs. And this is the beginning of the investment return cycle. I think often that this concept of investing in the club and assuring it's being invested in such that it stays compelling for prospective members and existing members, so the retention is high and the turnover is low. That concept is critical, but I've noticed in looking at all this data and working with different types of clubs, I've been in capital-rich clubs, many, and I've been in capital-starved clubs, many, and I see patterns that exist. And one of the things that kind of comes to the forefront of my mind is that it feels to me like playing golf. It's a little bit like a momentum game, like putting. When you're putting well, it seems like every putt goes in, and when you're not putting well, it seems like nothing goes in. And there's actually a cycle that exists, I believe. And that cycle for the capital-rich clubs is, it's a positive cycle. So they invest and they get returns, and we're going to look at this in detail, and those returns are allowing them to invest further, and they keep the ball rolling in the right direction. Versus capital-starved clubs don't invest, and therefore they don't have that compelling attraction for prospective and current members to stay. So they don't have the money to invest, and the cycle's going, but it's going in the negative direction. It's the ball's rolling the wrong way. So the whole point now is to see if we can learn something that might help those clubs break that cycle. And the clubs, the 50% of clubs in the middle assure that they get the ball rolling in the direction of the capital-rich clubs as well. So let's take a look first at the initiation fee for the capital-rich clubs versus the capital-starved clubs. Now, a lot of this is common sense, but I think seeing the data back up the common sense is really resonates, I believe. It's something that board members can relate to. It's something members of clubs can relate to. In the capital-starved clubs, the 25th percentile for initiation fee is $5,000. The median is $14,000, and the 75th percentile is $34,000. But when you look at the same breakpoints for the capital-rich clubs, it's amazing, but it's basically 2 or 3 times more. So 17, 40, and 70. So it's extremely different. So the initiation fee in these capital-rich clubs is much higher, discernibly higher. And the reason it is obvious, that they've invested more of their money into the facilities and the physical assets and amenities that exist. Therefore, they are more compelling. And I believe that, I really think that the initiation fee is, I don't think it gets talked about enough, frankly, from a strategic standpoint in the boardroom of clubs. And I think that it's almost like we all just relax to the reality of what our initiation fee is, as opposed to having the strategic dialogue around how do we increase it? What are the things we have to do to increase it? I believe that the initiation fee is a very good marker of the value proposition of a club, as viewed by the current members and the prospective members of the club. So in a club where the initiation fee is 0, the members of that club, manifested through the board, are essentially saying, we believe that's what the value proposition of this club is. And there could be a club 5 miles away that has a $30,000 initiation fee, where that group of people are saying, we think we have a higher value proposition. And you can see in the data that there's an effect of this. So there's a little bit of the chicken and the egg here, but I'm going to try and point to which one's the egg and which one's the chicken. So capital-rich clubs have an initiation fee 2 to 3 times more than capital-starved clubs.
Ray, I'm sorry to interrupt again. Another question actually came in through the chat, so I missed it. I think this might be for 2 slides ago. The question, they said, does the 12 to 15% include dues income?
No, it's not. It includes it's only that 12 to 15% number. So it's a ratio. The ratio is net available capital to operating revenue. The operating revenue number includes the operating dues revenue, yes. And the net available capital number, or that capital income number, includes any capital dues that the club would have had in that year. So on both counts, if you have capital dues, it would be included in the capital side of the ledger, but every club has operating dues, obviously, and that would be included in the denominator, which is operating revenue, total operating revenue.
Okay, thank you.
And by the way, on that juncture, if anyone is on the webinar and they want to calculate these ratios for their own club, and they're not members of Club Benchmarking, that's fine. Just send me an email. My email address will be at the end, and we'll send you the calculation so you can do it, and feel free to call as well. So let's take a look. It's funny we mentioned dues now, but this is interesting. Now, these are the operating dues, and it's only the dues. It doesn't include minimum spend or any level service fee or anything. But let's look at how much it costs to belong to a capital-rich club versus a capital-starved club. If you look at the breakpoints, it's almost identical in both sets of clubs. The median is $7,000. The 75th percentile is about $9,000, and the 25th percentile is about $5,500. It's almost the same in both sets of clubs. So people are paying as much to belong to capital-starved clubs as to capital-rich clubs. This is like a hidden secret in my mind in the club industry. The thought might be, I was at a beautiful Southern Legacy Country Club yesterday, probably one of the nicer ones in the country, and the dues at this club are about $6,200 a year. there might be this thought that the nicer clubs are more expensive, but as we see here, it's not the reality. The reality is nicer clubs are not necessarily more expensive, but they definitely have more members. So their dues engine is stronger as a result of more members as opposed to more expense. Now, there are obviously very nice clubs that are also very expensive, or relatively, but that doesn't have to be, that's not a prerequisite for being nice. So when you look at the capital-starved clubs and you compare the member count to the capital-rich clubs, what we find is capital-rich clubs have 40% or more members than capital-starved clubs. So they have higher demand. They have more members. And their higher demand is manifested by the value proposition marker of the initiation fee. It's basic law, as we all know, of economics, the most basic, supply and demand. The greater the demand, the higher the price. There's a limited supply. So if you take clubs in a given area, one has a low initiation fee, one has a high initiation fee, it's likely, very common sense, that there's greater demand for the club that has higher initiation fee. And the whole kind of point, this thing that I'm building here is, how do you create that demand? The contention is that that demand is created by investing in the club.
Ray, we had another question come in, and I'm sorry. It says, what is the correlation between the initiation fee and refundability? Is refundability higher or lower with the increasing initiation fee?
That's a very good question, and we have that data. I don't have it in the presentation, but I would say that a rule of thumb would be that the higher the initiation fee, the more likely there is some refundability to it. And when you get into that lower quartile of the industry right now, I'm talking about it for this particular question. I'm going to use clubs with golf for now. But if you look at clubs with golf, about a quarter of the clubs in the country have an initiation fee of $7,500 or less. And I would say that there's no refundability there. And about a quarter of the clubs in the country have an initiation fee of $50,000 or more. And in that segment, there would be refundability in some portion of it. My sense is there's a trend away from refundability after the meltdown. I can't say that. There's a date. I can prove that with data. It's my sense. But we have the data. I think that in that upper quartile, you might find that there's some refundability in about 40, 50% of the clubs.
Okay, thank you.
We have now this situation where we know these things. Capital-rich clubs invest a higher proportion of money into their club. They have more members, but they aren't more expensive to belong to. And if they have more members and they have a higher initiation fee, then their initiation fee income is going to be greater. So this shows the breakpoints for initiation fee income for the capital-rich quarter of the market and the capital-starved quarter of the market. The 25th median and 75th for capital-starved is 40,000. I'm rounding 100,000 and 300,000. Those same breakpoints in capital-rich clubs, 300,000, 750,000, and 1.8 million. So the combination of a higher initiation fee and more members joining, as manifested by more members in the club, shows as a 6 to 7 times a significant difference in the net initiation fee income that the club would have. Now, this is net of any transfer fees or any of that. This is what the club gets to keep. That's a massive difference, and it explains in large part why those capital-rich clubs are able to invest a larger proportion of their operating revenue back into the club. And so now we can see the investment return cycle is exposing itself. Now, there's another thing that goes on. In those clubs that are capital rich, they actually have more of the clubs, a higher proportion of them have a recurring monthly capital dues, and they charge more, as you can see here. So not only do they benefit from more initiation fee income in a massive way, 6 or 7x, but they also benefit from a much higher base of capital dues income, again feeding the ability to invest. Now, but the point here is this, that members in capital-rich clubs, probably the reason they pay more in capital dues, and the operating dues are the same, is because they're happier with the club and they're more willing to come up with the money, if that makes sense, than in the capital-starved clubs. So when we look at that combination now of total capital income, which is basically driven by initiation fees and capital dues, some capital assessments as well, you see a massive difference in the capital income in capital-rich clubs versus capital-starved clubs. Obviously, common sense. We're working our way back around the circle now. So they have more money to invest, but we saw why they have more money to invest, and it's a critical point. And the main driver of more money is twofold. A, they have more members, threefold. A, they have more members. B, they charge more in capital dues. And C, they have a higher initiation fee and greater initiation fee income. And that explains the difference in capital income.
Ray, I'm sorry to interrupt. We had another question come in. It says, they actually changed their question. Hold on. What is the total capital income ratio to total assets? Originally,
I'm going to actually. It's an excellent question, and it's actually the punchline of the presentation. So we're going to look at that in about 1 or 2 slides, and that's going to be the punchline. So whoever asked the question sees exactly where we're going. Yeah.
Great. Thanks.
So I'm just circling back. This was the first chart we started with that shows that these capital-rich clubs invest more heavily in their club, which we understand. We just proved it. I do want to show one. This is a little bit of a side step down a cul-de-sac, if you will, for a minute, because I think it's important. What we're focusing on here is, in our model, we look at the proportionate fixed expense by department, and we've noticed that many things with that. There's a lot that can be explained about clubs by understanding how the money is spent in a club. And I happened to see this, and I thought it would be a disservice to not highlight it. I'm focusing on the yellow pie slice, and this is the operating ledger now. But the yellow pie slice is the amount of the proportion of fixed expense that's expended on non-golf sports. So this is for the whole industry, by the way, so it would include city clubs and athletic clubs as well. But this is the aquatics, rackets, fitness, spa, youth. That money that's invested in those amenities. And you notice that in capital-starved clubs, about 10% of the fixed expense goes into those amenities. And in capital-rich clubs, it's 15% of the fixed expense at the club. So it's 50% higher. It's 5 percentage points, but 50% higher. And we can show with data as well that clubs that have a broader set of amenities offered, meaning the yellow pie slice is larger. As the yellow pie slice grows, so grows the initiation fee. And I put this in here to make that point. As we saw, the initiation fee is much greater in the capital-rich clubs, and that probably has something to do with it. It just is indicative of a broader array of services that are appealing to a broader array of the population, which increases the demand, which ultimately uplifts the initiation fee. Now, to the person that asked the question about the return on assets and net assets, and this is the punchline, and this is really the critical point. It's going to go back and tie this concept of return on equity back into the dialogue. What we do collect the data point, unrestricted net assets. Now, frankly, in doing this research, I noticed that we use the term unrestricted net assets. Some clubs might use total net assets. Total net assets may be a more a better way of describing it. But what it really is, as we all know, is it's ultimately the shareholders or members' equity. It's the equivalent of shareholders' equity in the for-profit business world for private clubs, which are nonprofits, are governed by the concept of unrestricted net assets, or net assets. And so this is the amount of money that is invested in the club. And if you look at the breakpoints for the capital-starved clubs and compare them to the capital-rich clubs, what we see is these capital-rich clubs have much more capital invested in them than the capital-starved clubs, which is a logical thought because they've been investing more for a long period of time, most likely. And I think the capital-starved clubs, clearly the meltdown had an effect on the marketplace. But I would contend that it didn't cause the capital-starved clubs to be in the predicament they're in. It accelerated it, but I think they were already in that predicament anyway. And I believe that it's because of the culture in the club. And we'll get into that after if we have time, but the point of this slide is to show that capital-rich clubs have a lot more invested. So that investment manifests itself in more expansive facilities, a broader array of amenities as in those facilities, nicer facilities that are more well-maintained. So they're larger and better. In capital-starved clubs, smaller and not maintained, let's say poorly maintained, not the same array of services and amenities, and a poor physical plant. So you can see the difference in the amount invested. But then the key becomes, to that person's question, what if we were to look at or try to determine if we could measure the return on the investment, just the way businesses do? So return on equity. And we put a lot of thought into this one and have gone back and forth. And frankly, this is a little bit of a groundbreaking exercise, although I think that the data is going to show, as we see it here in a minute, that it's valid. At first, when I started to dig into this, I was thinking, well, membership dues revenue, operating dues, must be part of the return equation. And theoretically, it sounds like it makes sense, but as you peel the onion, I concluded not the case. The reality is that it will help a club, clearly. It's going to help a club to have more dues revenue, operating dues revenue, no question about it. But ultimately, that dues revenue will be expended. It won't produce a financial return because we're in generally not-for-profit situations. And so that money will be consumed delivering amenities and services to members. But the way the return occurs is in capital income. So that's money that comes from current and prospective members, prospective vis-a-vis the initiation fee, current through dues and assessments. It's that total capital income that's actually the return. So the nicer the club, the more amenities and services it offers, the broader amenities and services, the more the demand, the greater the member count. The way that all manifests itself ultimately is how much capital income do we bring in? So what we did is we took the total assets, the total capital income across these two segments, capital-starved and capital-rich. And I looked at it at the 25th percentile, the median, and the 75th in both segments, and looked at the return on total equity and came up with the return. In the capital-starved clubs, it's 5% on average. In the capital-rich clubs, it's 13% over 2.5 times. And that right there is the story. So the issue here is, just as in a business, in a for-profit business, generally speaking, money will flow to higher returns. And that's true in clubs. We just proved that with the data in clubs. The higher returning clubs are the ones that attract the money, and it manifests itself through the higher initiation fee income and more capital income to the tune of 200, almost 250% greater than the clubs where the return isn't as great. And the return, we go to the next slide, well, the return is ultimately in the demand and the initiation fee. And I'll just, make a quick point, because this is also important. I started to wonder about debt. How would debt factor into this? Is there a different leverage pattern? Do capital-starved clubs have more debt than capital-rich clubs? And it's amazing, but it's almost identical. The ratios in the capital-starved clubs, debt to revenue, and capital-rich clubs are almost the same. There is no difference in the leverage or the makeup of the balance sheet, so to speak, in terms of debt and equity in capital-rich or capital-starved clubs. It's the same. So debt is almost identical. But one thing that is different is churn. So we know from the data that there is much higher churn in lower initiation fee clubs. And we've seen that the capital-starved clubs have lower initiation fees. The median for full member, we measure full member churn, is 8%. So 5, 8, and 11 are the break points versus capital-rich clubs, it's 2, 4, and 7. So it's double in capital-starved clubs. The membership churn is double in capital-starved clubs. So at this point, this investment return cycle, I believe, is this. More capital investment drives broader amenities and nicer facilities, drives great prospective member demand, drives higher initiation fees and more members, drives greater capital income through initiation fees and capital dues, equals a higher return on invested capital. So the question for every club is, what's your return on equity, which is the questioner asked earlier. It's in this way we're looking at it, it's your total capital income divided by your total assets. And I would contend, now there's I think about 120 people on this webinar. I'm sure some from one club or another, but let's say there's about 120 clubs. If everyone did that ratio, my guess is those with an ROE in that regard, let's say under 6, 7%, are probably going to be in clubs where you're going to see you have a low initiation fee. And those with the higher one, let's say over 10% into the mid-teens, you're going to be in clubs where you see a high initiation fee. And so I think that measure is important. And back to the whole point of doing all this work is this. What's the chicken and the egg? We have to get boards to think about these big issues. This is a critical issue. Think strategically, not worry about the cost of food. And I believe that clubs that are in that lower quartile right now, contrary to what the dialogue is in those clubs typically, and the dialogue is, we don't control our own destiny. No one wants to join. But the answer is actually, you do control your own destiny. The choices that you've made haven't been ones that attract capital. And you have to break the cycle, back to the cycle. The quarter of the market that's going in the right direction, they get all the momentum. The quarter of the market that's going in the wrong direction, the cycle has to be broken. And this is the discussion that's critical. And it starts with capital investment. It starts there. And the result will be higher capital income. And it has to be investment that will allow clubs, the thought exercise would be, what could we do, even if the initiation fee at a given club is $2,000, the thought exercise in that club has to be, what do we have to do to make the initiation fee $4,000? During the meltdown, what tended to happen was a not insignificant portion of the marketplace cut the initiation fee. And there was an assumption behind it. And the assumption behind it is, if there's a lower initiation fee, we'll get more members. The data shows that the higher initiation fee has more members. Clubs with a lower initiation fee have less members, and clubs with a higher one have more members. So I don't think the assumption's correct. The key is the value proposition. What are we doing to drive demand? Even if we're in a place where, let's say demographically or economically, it's not a great situation, the issue still has to be driving demand. Continuing to live as a capital-starved club won't solve the problem. So it starts with capital investment. I believe the investment return cycle is laid out right here on this chart based on the data we just saw. The higher capital income is a result of higher capital investment. It's not that the other way around. It's not that the ones that have higher capital income can invest more. No, they started the cycle by investing more, and they've been in that pattern. Now, just quickly, in terms of productivity, because this is important, there's different types of investments, as we all know. There's what we might call maintenance and replacement. So a new HVAC system, new parking lot, new roof. There's what I would characterize as expanding and or improving existing amenities. So a larger fitness center, a larger clubhouse, more golf holes, more slips and moorings if you're a yacht club, etc. And then there's the concept of adding amenities. Sometimes we refer to it as aspirational capital. This might be adding a fitness center in a club that doesn't have one, or adding a spa where a club doesn't have one, or golf learning center, or casual dining in a club that doesn't have that. Now, in those three types, the table here that is to address how you might measure the returns. This is the project view now. We just saw the high-level return on equity view. This is to take a look at the project view. I would say, generally speaking, that maintenance and replacement is a necessity, and some of them might have ROIs due to lower operating costs, as I cited the early example, HVAC, for instance. But I do think one of the key issues there is having a capital reserve study that's up to date, that spans the next 20 years, that allows planning to occur for that maintenance and replacement. Very few clubs in the country have a capital reserve study that's up to date and done by a third party. Critical issue. It's almost an ante. And generally speaking, the clubs that are capital starved haven't had capital discussions, and it's one of the reasons they are capital starved. That mid-grouping of investments, expanding or improving facilities and amenities, I think when you undertake those projects, we have to consider that there must be some return on them. We have to be able to tell ourselves, if we do this, we will either increase our capital dues above and beyond paying for the project, so we have more to invest in other things in the future, or we're going to increase our initiation fee, or both, or we're going to add more members that'll pay more in capital dues. So expanding, improving facilities and amenities is done to generate more capital income in the future, and clearly adding amenities, that's the whole point of it. The whole point of adding amenities is to expand the appeal to a broader prospective member set, such that there will be greater capital income through higher initiation fees, more members, and more capital dues. So for each of the three types of investments, there's probably, on a project-by-project basis, a little bit of a different assessment, but I think it starts with, lowering operating costs at the outcome and the adding amenities. You're into I believe that a project, you'll have to draw a line to make it pay so that you can move your return on equity, overall club return on equity. You want to move that up over time, like any business. And the way that we have to do that is by taking that adding of amenities and figuring out how we'll increase our future capital income because we've added the amenity. There are many clubs in this country right now raising their initiation fee, and that's the ultimate goal. So, in summary, the goal is to create this capital investment, capital income momentum. That's the goal. It starts by investing. The return is a higher initiation fee, more new members, and higher retention as a result to a broader appeal and more prospective members. the higher initiation fee and higher capital dues income is the return on properly invested capital, and I think we saw that with the data. I don't think that's an opinion. I think that's a fact. And I asked this question rhetorically, obviously, but I really think it starts here. This is the link to have the discussion with the board about how to make an initial, for the capital starved segment of the market, how to get that ball rolling. What can we invest in that will allow us to raise our initiation fee, even if it's only $1,000? But how do you start that cycle moving? And then the sum of all historical investments at any club manifests itself in this return on equity, which is total assets, total capital income divided by total assets at the end of any given year. That's the sum of what you've done in the past. So I'm just circling back to the learning goals that were in the synopsis. How much should be invested? We've looked at the capital investment as a percentage of operating revenue in capital-rich clubs versus capital-starved clubs. It's in the slides. The median's 10% in capital-rich clubs. We talked about how to measure investment productivity. I think the data shows clearly the productivity on an investment is increased capital income in the future. And then which projects are likely to be more productive? As we said, those that will drive higher initiation fees, more capital dues incomes from existing members, and higher initiation fees. And you know, this concept, the whole total net assets or unrestricted net assets, I started to think about this too. There's research to be done here, but I'll tell you something. I think that it would be a great exercise for those that are on the webinar. I'm going to take a look at this at my own club right in the next few days. We notice that there's a not insignificant proportion of the industry, it's on the order of that 25%, where the unrestricted net assets are going down every year. That's meaning that we are dying. Unrestricted net assets, the total net assets, should be increasing every year. And it would be to help the dialogue with the board for those that are on the call, or who are on the call, that want to break this cycle, or for those who want to continue it. One way of starting that dialogue is to look at the net assets, the shareholders, club members' equity over the last 5-10 years, and watch the trend. In the clubs that are in that upper quartile, it's increasing. In the clubs that are in the lower quartile, it's decreasing. In the clubs that are in the middle 50%, I would posit that there's a lot of going sideways. It must increase. The only way you see increased value is seeing that number increase. So with that, it's amazing. It's the first time I've done this like that, but I did 1 hour on the head. But if there's any other questions, I'd love to take some.
Sure. Thanks, Ray. There are a number of questions came in. I was saving. I saw that you were towards the end, so instead of delaying you, I figured at the end. So there was a question here, and they had a clarification, so I hope I'm reading it right. Is there a breakdown of the ratio percentage of total capital spent by departments, such as like golf course, clubhouse, infrastructure?
We do have that breakdown, yes. I don't have it in the slides, but we could generate something for the questioner if they want to send me an email.
Okay, great. Thank you. There's the next question. It says, what is your opinion of a club using PACE, Property Assessed Clean Energy, financing for solar power to reduce energy costs?
I think that's a very logical thing. That would be an investment, as the questioner intimated, that would have a return through lower operating costs. And frankly, it might have another benefit. You know, when we think about the millennials, it might have a benefit in terms of prospective members seeing that a club, you know, has that kind of a culture in it. So there might be a return in that regard too. But I do think that anything that, you know, you can measure very clearly what the return on investment would be in terms of the lower operating costs. You know, I think, not to get too technical, but if you were in a business and you were looking at a project like that and you were just thinking with a for-profit mentality, which is maybe not the way you want to do it in this particular case because of the green nature of it, but it would be interesting in that club for the questioner, if you did your own calculation of return on equity, so you take your total capital income last year, divide it by the total net assets, that would give you the club's return on equity. It would be interesting to compare the return on the solar project to that. If it's above that, then it would be a very logical thing to do because it would help increase the value of the club. And if it was below that, it wouldn't mean you don't do it, but, you know, it would maybe be something that would be further discussed.
Okay, great. The next question is, what is the percentage of depreciation to total assets in clubs? How does it relate to total capital income?
Yep, I can't, we could give you that metric, and same deal, please send me a question. I can tell you what the depreciation is as a percentage of operating revenue at the median. It's 11%. I can't tell you what it is as a percentage of net assets, but I'm quite sure it will be less, and my guess is it's going to be, I don't know. We'll generate the slide to the metric, but I know depreciation as a percentage of operating revenue at the median is 11%.
Okay, thank you. The next question says, long term, is it more beneficial for a club to have higher initiation fees with lower ongoing capital income, or lower initiation fee and higher ongoing capital income?
That's a great question too. So I think in terms of ongoing capital income, I'm guessing the question is referring to recurring capital dues, which we believe the data shows is a very wise thing to have for a club. I think that, I don't know that it matters which way you get there. I'm thinking out loud here. I think that my sense is I would always favor a higher initiation fee if you can get it. So because it goes back to the value proposition of the club. So I think there's a third alternative there, which is a higher initiation fee and higher recurring capital income. Maybe both exist. I think when you're doing your modeling to answer the question, if you take the two scenarios you have in mind and you rough out what you think your capital income is going to be each of the next few years looking forward, and you take the two scenarios and say what percentage of the operating revenue is that, as long as they're both in that 12 to 15% window, I think it would be, you know, it's kind of like a painter's choice then, whatever you feel the best style is. If one of them leaves you with under that 12 to 15% window, then you might have to revisit that model, because that probably wouldn't be the one you'd choose.
Okay. There's one last question in the statement. This question was actually for me. Yes, you will get a copy of the presentation. It will be made into a PDF that will be made available on CMA University along with the audio recording. So somebody had asked that question. And we just had a statement from somebody that said, thank you for enforcing the fact that clubs need to break the cycle of lowering initiation fees, thinking that it will increase membership. Many boards just don't understand this. So one of our attendees had wanted to thank you for that. So they see the need for that. I don't see any other questions. And so Ray, thank you so much. We appreciate your time today, and I want to thank everyone for their time today as well.